Hey everyone, welcome back to my channel. James here. In the past few weeks, major banks have raised interest rates, and people in Singapore obviously love it. In fact, the interest rates in September itself are going up as high as 3.5% for a 50k deposit in Citibank. Whereas for the local banks, both UOB and OCBC are offering 2.6% for a 12-month fixed deposit. With all these attractive interest rates, people are trying to open up a fixed deposit account and the queues are stretching from 2 to 4 hours long. However, while the fixed deposits can protect your capital during this uncertain macroeconomy, there's just one small problem. Fixed deposits are offering 2 to 3%, and it is not enough to keep pace with our current high inflation rate of more than 5%. With that, I have come up with 5 defensive stocks that offer dividend growth as well as at least 4% dividend yields. With that, let's dive in and check out how I can screen out these dividend growth stocks. But before that, alright, we appreciate if you can help us tap the like button and subscribe to our channel so that I can reach out to more people who like such stock analysis videos. Thank you. I'm gonna just come up with 4 simple criteria. The first one, of course, we have to select our market. So right now we are selecting SGX. Okay. The first criteria will be the dividend yield. It must be more than 4%. Okay. So if it's lower than 4%, then you might as well go for fixed deposit, right? So we have to go for more than 4%. And then the next one is that we want the company to have a strong balance sheet. And in this aspect, I'm going to go for net debt to equity less than 1 times or less than 100%. Okay, the third criteria will be this, okay, compounded annual growth rate of dividend per share. That means we don't want them to just pay us 4% yield. We want them to grow their dividends per share for more than 2% in the past 3 years. So you are looking at a dividend growth stock, right, with more than 4%, and yet it has already grown its dividend per share more than 2% for the past 3 years. And then last criteria that we have is free cash flow. That means we want them to have business models that churn out free cash flow, and it has to be more than zero. That means it's positive free cash flow for the past 1 year. So our first stock on the list is Siong. Siong is our local supermarket operator, favorite for the moms and pops out there. All right, it has been established since 1985, so a very long history in the making. And right now, they operate more than 65 locations across Singapore and has over 1 billion in sales revenue for the latest year. So with that, let's take a look at their dividend statistics. Criteria we look at is the dividend yield. For Siong, dividend yield is 4% as of FY 2013, and throughout the years it has been giving out 3 to 4%, and FY 2021 has been giving out 4% as well. Okay, now let's look at their compounded annual growth rate of the dividends per share. All right, year 2013 is 2.6 cents. Year 2021 is 6.2 cents. So that's around a 3 times leap over the past 9 years or so. And if you look at the past 3 years, the dividend compounded annual growth rate is 22%, predominantly because of the COVID hype up demand. Alright. Next, let's look at their net debt to equity. That means their balance sheet. So right now it's all net cash. That means they have a very robust financial position. The total debt to equity is also very manageable, below 0.2 times. So below 0. Anything below 1 times is already considered very manageable. And right now, Siong has 0.17 times total debt to equity. And whereas for the free cash flow, all right, I think in the past, maybe beginning of the years, they have been expanding their stores. Right now, they have a free cash flow that is totally positive and increasing throughout the years. The last part is this future developments. So future developments of Siong is somewhat muted because they say that alright, elevated demand may taper in year 2022 because everyone now can travel overseas and all that, and there's no elevated demand for their goods anymore, for the groceries anymore. And then next, they also suffer from higher input costs because of the supply chain disruptions and rising inflation. However, they are also expected to grow steadily because they're gonna open up 3 to 5 stores per year in the next 3 to 5 years. So you can see that Siong will continue to steadily increase their locations across Singapore itself. Next stock that I want to talk about is the HrnetGroup. It is a luxury watch retailer with a network of more than 50 boutiques in the Asia Pacific region. It carries many famous brands like Rolex, Cartier, Cartier, and more. For the HrnetGroup, the dividend yield is pretty decent. FY 2013 is 3.6%, FY 2022 is 4.8%. In fact, in the last year itself, they went up to as high as 8.2%. Okay, next, we look at the compounded annual growth rate of the dividends per share. So to give out this 5.5 and 6 cents, after which they sort of tuned down to around 2 cents, and then in the past 2 years itself, they give out the total dividends per share of 6 cents and 8 cents. So the past 3 years dividend CAGR was 38.67%. If you look at the net debt to equity, they have been in the net cash position throughout the years, and their total debt to equity is also at a very manageable level, 0.1 to 0.28, maximum to 0.29 times. Free cash flow positive as well, 3.3 million in FY 2013, and then increase all the way to 212 million in FY 2022. As for the HrnetGroup future developments, Mr. Michael Tay, the group MD, says that the performance was boosted by a significantly broadened fascination in high-quality mechanical watches. They believe that the demand momentum will likely continue and will focus the attention on organic development throughout the Asia-Pacific region. The third stock on our list is HrnetGroup, a leading recruitment firm based in Singapore. Today, they have over 900 consultants spread across 13 Asia cities, and they possess 12 brands including the likes of Recruit First, HrnetOne, and of course, Recruit Express. As for the dividend statistics of HrnetGroup, okay, their dividend yield has been steadily increasing from 2.8% in year 2017 to 6.6% in the trailing 12 months. Compounded annual growth rate of the dividends per share, right, is also growing throughout the years from 2.3 cents all the way to 5.13 cents. So that's almost like doubling in the past 5 to 6 years. In the past 3 years itself, their dividend CAGR is around 12.62%. All right, from 2.8 cents to 4 cents. That's 12.6%. The balance sheet, okay, their financial position is also robust. All right, net cash all the way, and even their total debt to equity is almost close to zero. And they have always been free cash flow positive, churning out 34.3 million in free cash flow all the way to 81.7 free cash flow in the trailing 12 months as of June 2022. As for their future developments, all right, in their two major markets, the Singapore and China markets, Singapore has been looking at wage rising rapidly since first quarter 2021, and the China urban unemployment rates have been coming down, maybe because that the COVID lockdowns have eased and people are going back to the normal working environment again. The fourth stock is none other than our local bank, OCBC. It operates in key markets such as Singapore, Malaysia, Indonesia, and Greater China. Their subsidiaries include Great Eastern Holdings, OCBC Securities, Lion Global Investors, and more. Okay, now let's look at their dividend stats. Okay, OCBC has always been paying great dividends. So you can see from here that their dividend yield is always above 3% throughout the past decade. And if we look at the total dividends per share, right, their dividends have been increasing steadily from 34 cents all the way to 53 cents, dropped to 31.8 cents because of the COVID pandemic. They wanted to be more conservative. And afterwards, they rebounded to the 53 cents as of FY 2019 again. And we can conservatively say that they are going to increase it going forward. And for the past 3 years, dividend CAGR is 7.22%. Although you can say that, if you measure this, that is somewhat like a very steady growth that you can see in their dividends per share. As for their net debt to equity, all right, because they are a bank, okay, we are just looking at the net cash portion, all right, but their total debt to equity is also pretty impressive. It's always below 1 times. Although when you look at banks, they tend to have quite high of a net debt to equity due to they categorizing all the bank deposits as the debt itself. And if you look at the free cash flow, right, OCBC has been also churning out free cash flow from 6.5 billion all the way to 20.1 billion as of June 2022. And for their future developments, looking ahead, OCBC is saying that their growth in Asia remains positive because there's a continued economic growth in their key markets, although at a slower rate. There's improving unemployment rates and, of course, the reopening of borders, especially the easing of lockdowns in China. However, they are also cautious on the near-term headwinds, such as the supply chain bottlenecks, recessionary risks from increase in interest rates, potential rise in default rates. So we have to balance out and see whether it will be more positive because of the rise in interest rates or that it will lead to a major severe recession going forward. The last stock we want to talk about is HC Surgical. As you can guess from their name, this is a healthcare stock that provides colorectal or gastric procedures across a network of 16 clinics located throughout Singapore. As for HC Surgical dividend stats, alright, okay, 4.2% dividend yield in year 2017, increased to 10.6% in year 2021. And as of May 2022, it came down to a bit of 5% dividend yield. Okay, if we look at the dividend per share, this may tell us why the dividend yield is so high. They increased from 2.5 cents to all the way to 4 cents in the last year itself. Maybe because the COVID pandemic has been over and they have a pent-up demand, increase their profits as a result. And then they decided to give out more dividends per share. But it has came down a bit to 2.6 cents. So this may be more the normalized kind of a dividends per share going forward. And we look at the past 3 years dividend CAGR is around 5.7%, still a relatively stable growth rate to take note going forward. All right. And talking about their financial position, they have a net debt to equity, okay, pretty manageable. Net cash all the way except year 2020 is 0.058 times. Total debt to equity 0.8 times in the last year. All right, but also came down to 0.56 times, so still manageable. Free cash flow, they've always been free cash flow positive as well, so that explains why they can be able to pay out dividends, right, throughout the years. So 1.1 million to around 7.5 million in free cash flow as of May 2022. And talking about their growth prospects, okay, moving forward, the company has been appointed by AIA as the provider for colorectal cancer, all right, for second term. And then they are also expanding and constructing another endoscopy center in the East Coast. With that, we have come to the end of the video. We hope that you have liked the video and can give us a thumbs up as well as subscribe to our channel for more such videos. We'll see you in the next video. Bye.